Hey guys, a lot has been said about Berkshire Hathaway selling its stake in Airlines, which was first revealed at the 2020 shareholders meeting a couple weeks ago. And again, there's been many different angles on why Buffett and Berkshire sold the airlines, but I thought I would break it down into the basic components that drive the profitability of any business and look at the airlines through this model. So we can think about a company's return as being the product of how capital intensive it is and the profit margin that it generates. So how much, what a return on the return on capital that you generate is the function of how much capital you need and how much it earns. That's pretty simple. So we'll take a look at those two metrics, and then we'll also take a look at the third metric, which is the return that the shareholder actually gets. So you take what the company itself earns and then adjust that by the dilution factor. So dilution could be negative when a company is buying back its own shares when they're undervalued, or it could be dilutive. So taking a look at this framework, we can take a look at how the airlines will fare. And cutting right to the chase, all three are negative. So capital intensity is simply the amount of revenues that are generated per dollar of capital employed. And we think about the airlines, we think about how the pandemic will affect their revenue streams. And of course, the revenue streams are going to go down. So with the same amount of capital employed, because you can't fly an airplane, you can't fly half an airplane, you have to fly the whole thing. So airplanes are very capital intensive, and it's sort of a binary go no go kind of business operation. So as people start to pull back on flights and flights become less full, either because the demand isn't there or government regulations or even consumer behaviors change such that, if you had to have every other row or every other seat empty or otherwise spaced out, that's going to affect the amount of revenues that an airline can generate uh, per dollar of capital employed. If we next move on to profit margins, so as a very high fixed cost business, airlines are very susceptible to drop-offs in utilization. So below maybe 80%, 75, 80%, airlines become very, very unprofitable because those first few passengers are what pays for the plane itself, the upkeep, the pilots, the flight attendants, and so forth, the fuel. It's only when you get to those last few passengers that an airline starts to make a profit. And prior to the pandemic, airlines had been achieving those high, they're called load factors, and they were quite profitable. But once you fall past or below that certain threshold, your profitability drops off very substantially. Um, and then there's also an added element of interplay between industry capacity and profits. So if we remember back, if airlines are not flying as many planes, that means capacity is going to be high, which means airlines are going to compete very aggressively with each other to get that marginal passenger. And Buffett has said this before, it's very hard to distinguish between the marginal passenger and the average passenger. So you're going to have airlines fighting over each other to drive volume so that they can drive profitability. But in doing so, they shoot themselves in the foot by driving down the average price and therefore the average margin in the industry. So those two factors taken together are negative. and will affect the underlying profitability of each individual airline, each company. But then you have this added factor where the government will be stepping in many cases to provide loans or grants or some combination of the two to the airlines in exchange for uh, warrants or some kind of ownership stake in the business. So not only will the future earning power of the businesses decline, investors will have a smaller stake in those future earnings. And that happens with explicit dilution in the case of warrants. And it also happens when a company borrows additional money to fund losses. So you can think of, if you just think of a company as basically financed by debt and equity, if debt increases, but the company's earning power stays the same, the equity component shrinks. So if you're placing the same value on that same equity slice, that means you're saying implicitly that the company is worth more, which we know it can't be the case. So by taking on additional debt, it means that the enterprise value is staying the same, but the equity value is shrinking. So Buffett recognizes those factors in play, and any one of them, capital intensity, profit margins, and dilution, can impact the return that an investor receives from owning a business. But when you combine all three together, it really spells disaster. And people are looking. Some investors are looking at the decline in the in the share price of these airlines and saying that it might be a good time to buy. Buffett clearly thought otherwise, and he's exiting Berkshire Hathaway's investments at a loss. And there's another lesson in there that even if your investment is in a loss position, it still might make sense to sell if the differential between price and value has changed, which is very likely that that is the case. So as with anything, we will find out in the next 5-10 years whether Buffett was right, but it certainly never usually pays to bet against the Oracle of Omaha. But time will tell how this plays out. So if you enjoyed this video, please consider subscribing to the YouTube channel. We also have at theoraclesclassroom.com a whole host of blog posts, Berkshire financials dating back to the 1930s, financial statements on all of or most of Berkshire's subsidiaries, especially the ones that were public, as well as some other resources, book recommendations, and so forth. So thanks for watching. Hope everybody has a good day, good week, and tune in again soon. Take care.